morning. Welcome to the Dr. Kennedy podcast. And I want to thank you for listening the other day to my first class in over 6 years. I've been out of the classroom for 6 years, and it felt good to go back in the classroom and be with students and exchange ideas. I really enjoyed it. And I hope you enjoyed it. Hope you see that at the Daniels Foundation that we really try to mold students in several fashions. One is definitely the educational content, but we also try to motivate them to aspire to uh, find some connection to something larger than themselves. And sometimes very hard to do, but it's very rewarding to make the connection. So, yesterday I was a little rusty, and today I hope you'll take note of what I'm trying to do and be inspired by what I'm trying to do with the foundation and connecting to students and improving society and make sure we have the right resources in the Black community to do the things that are necessary for not only here in America but across the world. So hopefully you'll support me in my mission. And the foundation needs financial resources. So I'm hoping that somewhere out there that someone's going to see some of these videos and really willing to contribute to the Daniels Foundation and help us achieve our goal of producing the best talent so we can produce the best results for the people of the world. So today, sit back, relax, and you'll see class number 2. And thank you very much for watching. We appreciate all support. Have a great day. And so again, today's going to be our research day. So again, I want to welcome you to the class. And I'm excited today because today I get to sit back and critique the level of skills that you have in terms of understanding research and presenting research. And so today you're going to use the screen share. So I'm going to go out here and allow you to use the screen search to share your research just like I did. We'll try that. If it doesn't work, don't worry about it. Then we'll go to some other method. But we're going to allow you to share the screen. So I just want to demonstrate that first, that as we go through the research presentations, that hopefully on your Zoom, you're able to see the green icon here called share screen. So you'll click on that, and then you'll go up and hit the blue button, and then hopefully that will allow you to share your material on your computer or laptop or however you want to present it. So we'll try that. If you have problems, we won't worry about it. If we have problems, then we'll just go ahead to some type of verbal discussion of what you found, and we'll have a discussion among everyone in the class. Okay, I would appreciate if everybody at least turns on their video. So Mr. Mulana, could you turn on your video, please? Thank you. Okay, and so let's go first. Ms. Kadis, is your team ready to go first?
Yes.
Okay.
I'm ready to be first.
Okay, let's go. Why don't you start us off?
Okay.
The floor is yours.
Let me share it.
Okay.
Yeah, it's coming.
Yet?
Not yet.
Yes.
Yeah, it's coming now. Yes.
Can I start now?
Yes, you may.
Okay, thank you for giving this chance to make presentation for our group as well as for our teacher. Then thank you for giving this nice chance to review or how to review research and how to analyze, how to understand and all those things. I'm trying to present the paper entitled with the evolution of Fintech, that means financial technology and new post-crisis paradigm. It is the paper written or reviewed by Douglas Arney, Janos Barbaris, and Rose Walkin. And this paper is presented by will be presented by Qedist, Abdullah, and Desalegn. And we group on 3 parts. And the first will be presented by me, and the next Abdullah and Desalegn, respectively. Does it move now? On the introduction part on this finance technology or fintech, starting with define what the word mean, what are the related concepts rise with this issue. Then they start by defining the concepts, what finance technology mean. It is the use of technology to deliver financial solution. Again, this term is origin can be traced to the early 1990s, and on that time, it referred to as financial service technology consortium, and this finance technology is initially the project. Can you hear me?
Yes, we can. Yes.
Yeah. Then the project initiated by Citigroup to facilitate technology cooperation effort. But all these things started for the period, but they get attention on regulation and industry participation from the 2014 onward. But the concept is starting, or the issue of finance technology is on early 1990s, when practically they get regulation, industry practice, as well as consumers in 2014. Then this term, this finance technology, it is a large and rapid growth industry, and it's represent with US dollars of 12 billion to 197 billion invested as 2014. Therefore, when we talk the concepts of finance technology, it's not a simple term. It is not the recent issue, but it is starting on early, and it had a huge contribution, and it had a large growth industry on the world. Then finance tech today is often seen as a unique recent marriage of finance service. May people assume that the concept related or rise on a current situation, or it is a recent activity, or it is a recent thing, but it is started on early period. Then finance technology today is often seen as a unique recent marriage of finance service and information technology. However, the issue are interlinked. So finance technology has a long history relation with finance and technology. In fact, finance and technology development have long been intertwisted and mutually reinforced. Therefore, when we talk finance technology, may some people assume that the concept is the new one, or the concepts of finance they know separately, and the concepts of technology they know separately. But may they don't think that they come together and they perform together in a lot of activities. The global finance crisis, we abbreviate GFC, of 2008 was a watershed, and it's part of the reason finance technology is now evolved in a new paradigm. There are periods we categorized in different eras of this, the relation between or the evolutions of finance and technology. But after the 2008 global finance crisis, there is a new paradigm shifting, but the concept is not the new one. The concept is started on early period, but they have some new paradigm shifting from the early concept. This evolution poses challenges for regulators and market participants, particularly in balancing the potential benefits of innovation with the potential risk. Therefore, that the new paradigm thing may has some conditions, some issues, and this condition may challenge for regulators as well as market participants. On their paper, they try to analyze as an objective, analyze the evolution as well as outlook for the fintech sectors and consider the regulatory implication of its growth. On their paper, they try to see the evolution of the relation between finance and technology. Again, they consider the concept related with its regulation. It does so by first consider the interlinked evolution of financial service and technology. They start their review from analyzing, from collection, from reviewing the evolution of financial service and technology, especially or particularly with information technology. Then the evolutionary analysis is then used to develop a topology of fintech landscape today. Then focusing on the impacts of the global finance crisis of 2008 and related post-crisis regulatory development. They tried to see all those things, starting from considering the interlink between finance service and technology, and they also tried to see all the things of finance and technology even after the global finance crisis of 2008. And they categorized under 3 eras of the evolutions of finance technology, and they grouped it under 3 eras. The first one is finance technologies 1, and the second one, finance technology 2, and the third one, finance technology 3 eras. Then it's grouped under 3. The first one, that means the finance technology 1 from 1866 up to 1967. And the second group on 2, it is from 1967 up to 2008. That means up to the date of global finance crisis. And the last one is from 2000 onward. Then on this, the first era, that means the finance technology 1 from 1866 up to 1967, it is called the analog to digital, from analog to digital. That means they tried to see the relation or the interlink of finance and technology evolution, and that is characterized by an analog situation or an analog condition. From around 1866 to 1967, the financial service industry, while heavily interlinked with the technology, remaining large analog industry, it is called or characterized, they characterize as Fintech 1. Finance has its origin in administrative system for state administration, necessarily in the transition from hunter-gathering group to settled agricultural setting. Even on such situation, for example, in Mesopotamians, there is the news, there is the issue that show there is record evidence of finance transaction. Even within this period, on situation, people live in a hunt-gathering group as well as in agricultural situation. There is also the concepts of finance. There is a concepts of technology. Therefore, to show this, to imply this, the researcher writes the evidences of finance transaction, notes the issue of current, the issue of the period. It is the issue of the earlier condition or situation. Similarly, the development of money itself and finance are clearly intertwined with flat currency, the technology evidence transferable value being one of the defined characteristics of a modern economy. The money, the developments of money, it's also show the interlinkage or the intertwist between finance and technology on this era or on this fine technology 1. One sees a similar process in the emerging of early technology for calculations such as abacus. Abacus also and one of the example that the existence of relation between finance and technology. This evolutionary development can also be seen in the context of trade with finance. They also tried to see the relation between trades and finance. And on this evolution from the early stage, both the support trade, for example, finance and insureship and infrastructure such as bridge, railway, and canals, as well as support the products of goods for that trade. They also try to see the relationship between trades and finance through this way. There is the concept. Again, double entry accounting, also an implication of the, that is to show the relation between technology. Another technology fundamental to the modern economy emerged from the intertwisted evolution of finance and trade in the late mid ages. Therefore, all these things are explained on their first stage or on their the initial fintech ages or eras of one. Again, they group this part on two. Based on, or they use the boundary lines of First World War. Then they group these eras into two. The first age of finance globalization, and the other one is after the First World War. Then on this, they try to see in the late 19th century, finance and technology combined to produce the first period of finance globalization that led until the beginning of the First World War. They group this period based on the starting periods of war, and they group before First World War and after the First World War. During this period, technology such as telegraph, railway, canals, and steamship underpin finance interlinkage across borders, allowing rapid transmission of financial information, transaction, and payment around the world. All these things are implication of the relation between finance and technology on this period. James Keynes, his writers in 1920, gives a clear picture of the interlinkage between finance and technology in this first age of finance globalization. He issued, there is the clear picture that show the interlinkage between finance and technology, even with that period. The other group, the early post-war period. During the post-war period, while finance globalization was concentrated for several decades, technological development, particularly those arise from wartime, proceeded rapidly, especially in communication and information technology. Then after the First World War, there are a numbers of obstacles, there are a numbers of constraints. Then to alleviate this, they tried to increase rapidly all the use of technology. For instance, in 1915, marked the period where Americans were introduced to credit cards. Again, initial establishment of the Interbank Card Association. Now it's called MasterCard in the US, 1996. By 1966, a global telex network was in place, provide the fundamental communication necessarily on which to build the next stage of fintech development. Again, the first commercial version of the successor of telex, the fax machine, was introduced. All these things are created or established or produced after the the First World War, but they grouped it under the first era. Then all these things are the relation on finance and technology, and all these are the products that produce or the innovation, the technology that show how much the finance and the technologies are intertwisted or interlinked. The second era is, they call them fine technology 2. It is the period from 1967 to 2008. That means it is the period up to the great financial crisis existing in 2010 and development of traditional digital financial service. It is developing on traditional digital financial service. The launch of the calculator and the ATM in 1967 began the modern period. We call it, or they call it, finance technology 2. Then the period grouped on two ways, or the first era and the second era is separate with the creation or the launching of ATM as well as calculator. Starting in 1967 through 1987, financial service moved from analog to digital industry. By 1987, at the late, financial service, at least in developing country, had become not only once again highly globalized, but also digitalized. On this period, or in this second era, the financial service show high increment with the high globalization as well as with digital concept. This period, which they are characterized as finance tech 2, continued until 2008. Then on this period, in the area of payments, they show different innovation. They show different finance technology relationship and the output. Then to list them or to give example on, for example, on this period in the area of payment, the Intercomputer Bureau was established in UK in 1968, forming the base of today's bank automated clearing service, while the US Clearinghouse Interbank Payment System, or CHIPS, was established in 1997. All these things are the witness for this, the second era. Fedwire, originally established in 1918, became an electronic instead of telegraph system in the early 1917. Again, Society of Worldwide Interbank Finance Telecommunication, or SWIFT, was established in 1973. Then all these things are the output or the fruits of the second era. Here, the collapse of Herstan Bank in 1974. It is a Germany bank and collapsed in 1974. Then it's imply or it's lead them to clearly highlight the risk of increasing international financial interlinkage, and particularly through the new payment system technology. When they, after this period, they try to talk, or this crisis triggered the first major regulatory focus on finance issues, and in the form of a series of international soft law agreement on development, robust payment system, and related regulation. Then after this crisis, they tried to regulate issues or regulate some agreement. That agreement is soft law, and on the issue of finance technology issue. In the area of security, the establishment of NASDAQ in the US in 1971 and the eventual developments of national market system marked the transition from physical trading of security to today's fully electronic security trading. Also, it is the fruit for this, the second era. In the consumer area, online banking was first introduced in US in 1918 and in the UK in 1983. Again, in 1978, marked a new period of regulatory attention to the risk of cross-border financial interconnection and their intersection with technology. All those things are explained or listed on this. By the late 1918, financial service had become largely digital industry based on electronic transaction between financial institution, financial market participant, and customer around the world, with the fax large having replaced telefax. Therefore, it is also by the late 1918, there is replacements of telex by fax. And by 2005, the first direct bank without physical branch emerged in the UK. That means that there is no physical existence on branch, or there is no physical branch. It is only online activities are undertaken. By the beginning of the 21st century, bank internal process, interaction with outside, and even increased numbers of their interaction with real customer had become fully digitalized. Therefore, the main or the special future for this era is the concepts of digitalized. In addition, regulators were even more using technology, especially in the context of security exchange. And by 1978, computerized trading system and recorder became the most common source of information regarding market manipulation. Then on this paper review, they categorized the era under 3, and the first two, that mean the era 1 and the era 2, is presented just like this. And the third era and the remaining parts are presented by our friend Abdullah and Desalegn, but I'm finished here. And if you have question or comment, I respect all those things.
Okay, thank you. We'll hold comments to the end, so we'll go with the next presenter. So if you could unshare the screen, and we'll go with who's next.
Okay. May I continue?
Yes,
Allow
sir.
me to share the screen.
Yes, you may.
Okay. Is it visible?
Yes. Go right. Go right ahead.
Okay. Welcome. Thank you, Curtis. So we are talking about the interesting issue of evolution of financial technology. Sometimes we may use interchangeably technology and the finance, tech fan, or it's a marriage of technology with finance. It is a big change in the world. So let me start with the third era of this revolution. After a global financial crisis, everything is changing. So starting from the our mindsets, the mindset of investors, and so on. Banks are failing. The technologies are challenging the traditional way of financial intermediation. So this is happened because of different actors are created in this market. Global financial crisis of 2008 is raising a question on traditional banking service, because of those crises are create huge questions, large question on those banks. Banks are failed to serve, fails to deliver the basic requirement of consumers protection, resource allocation, and so on. So there is a factors which drives for development of this fintech, especially in both worlds, including developed and underdeveloped countries. There are driving factors like public perceptions, regulatory requirements, political demand, economic conditions are the basic requirement for those advancements and the explosions of explosive growth of these financial technologies. So when we come to talk about this factor in terms of developed world like Europe and the US, it's mainly driven by public expectation and the demand. These are because the expecting movement of technology company into our world, in the political demand for more diversified banking system. In Africa and Asia, it's driven by the need of development, and because of their our market is inefficient financial system. So the two impacts are public perception on banking is deteriorated because of in US there is poor lending, predatory lending, which is causing financial institutions to fail, leading kind of this global financial crisis. From global financial crisis, which also leads to the global economic crisis. So at that time, Americans and the world star lost a lot of jobs. Americans, for example, lost up to 8.3 8.7 million people are lost jobs. Professionals are lost jobs. So new fresh graduates are looking for new opportunities. This Fintech is one of those opportunities. So after this global financial crisis of 2008, there is high regulation is increased, regulation after regulation, reform after reform. So these events, these reforms leads to more reshaping of the business models of banking system.
Can I stop you for a second?
Okay.
Can you go back to your last slide?
Okay, post-crisis.
Can you go back one more? There's one more. Go forward. You have a typo in your slide. Go back. Not back. Go forward. Go forward. This typo. Anyway, keep going. Keep going. Go forward. Go forward. One more. One more forward. Try one more forward. One more. Okay, you're going backwards. I want you to go forward.
Now, from the beginning.
Just go forward. Yes.
Okay, this is first page.
No, go
second page.
Just keep going. Keep going. I'll find it for you. Keep going. Keep going. Forward. Keep going. Keep going. Keep going. Keep going.
This is last page.
Keep going. Keep going. Well, you have a typo in there somewhere. You misspelled the word this. I want you to check it. My point is this. When you have a software like this, it's very easy to do spell check. It's unacceptable. It's unacceptable to have a typo in your presentation.
I don't get the point.
You misspelled a word.
Okay.
So right away, you have denigrated yourself to your audience because the people that are looking to knock you down for any reason possible, you gave me a reason to mess up your presentation. So now we're talking about a misspelled word when we should be talking about financial technology. You understand?
Okay, shall I continue?
Do you understand?
Yeah.
Okay, go ahead.
Okay, let me continue from this this part. So after global financial crisis of 2008, there is reforms in the markets from the developed world. So those reforms are resulted increasing the competitiveness of traditional banks. For example, the Basel III increased capital requirement by banks are one reason challenging the traditional way of bank operation, which rise the compliance cost on the banks. From other perspective, from political perspective, there is an increase unemployment and there is a need for credits by public at large. So this is also creating huge questions about political elected representative. For example, in USA, there is an act, Jumpstart Our Business Startup, which is for abbreviated Jobs Act in 2012. Almost is, according to the authors, it is politically motivated. But as a result of this act, and there is emerging of fintech startup, which is highly explosive increase in revenue from the peer-to-peer lending platform industry, which is now an opportunity, a growing area for financial technology development. So when we come to the other part of this article, financial technology industry today, the topology is divided mainly in 5 areas: finance and investment. Finance investment is also growing highly. It is high high frequency trading, like there is a NASDAQ, trading of stocks are highly increased. The frequency is becoming so strong. The investment is becoming so strong. So still, there is a replacement of traditional financial advisorship by so-called robo-advisory service. Stock tradings are now become advised by robotic system of advisors. So the other major development of today is that operations and the risk management areas. So the development of finance theories and the quantitative techniques are also helping to manage risks and maximize profits. It's also a major concern today in the world. The other is payment and the infrastructures, payment system. This is also tremendous growth in this area. So the cash systems are now becoming obsolete. Now it's becoming to be replaced by some kind of global currencies, cryptocurrencies, and the sorts are so growing. Not only in domestic market, also across broader transactions are so booming. The other fintech development industry today is that of data security and the monetization. So the issue of security is becoming even national security issues, because almost this fintech is opening for cyber attacks. Cyber security accidents are so increasing. So the value of big data, monetary value of big data, are also requiring valuation on the financial statements, are also is a question of the today. The other is that the requirement for customers interface, particularly online and the mobile financial service, are also demanding. So there is this means of competition also. This area is also part of becoming a competition between traditional banking and fintech banking system. My other area of concern is topic is that about the financial technology and emerging markets, Asia and Africa. The authors are this area they are calling Fintech 3.5. They are bringing the growing area, the fertile area of financial technologies, Asia and Africa. So Asia is the biggest consumers of financial technology, which is led by China, followed by India, Hong Kong, and Singapore are main users of those financial technology products. But producers are Europe and the Americans. So there is huge increase in the investment in financial technology. So this growth are attributed by different factors. Either it is side of institutional side and the infrastructure side. So the Asians and the Africans are their market is less competitive. There is state high control, weak public trust on the banking system. So there is corruption and so on. This is also leading for more acceptance of financial technology. The other is in terms of infrastructure. So those areas are less developing when we compare with Europe and the USA. So mobile-based financial service and the products are comparatively more attractive in the region. Still, when we talk about the financial technology, China government's reform is, so it is kind of policy driven, also politically motivated. For example, when we talk about the support of China government for this financial technology payment system, Alipay system developments they are highly helping government policies. For example, when we add Alibaba Giacomo, it's supporting government policies for job creations, even the development of small-scale businesses by giving loans, and even this payment system of UNAME pay card, it's becoming so global. Even got acceptance in the Africa, including my country, Ethiopia. So China transaction is both, the Chinese transition is both demand driven, policy driven. Let me show you that there is a figure which shows banking demographic, the delivery in channels in China, USA, and UK. So the figure is so financial inclusion, level of banking, number of bank owners in China is so low. In terms of SIM cards, mobile bank subscription, still there is an opportunity for growth in China. Overall, when we talk about, according to authors, financial technology is growing, growth is non-stopping in developing world, including Africa. So this is rationalized by young digital savvy population, which are young people, populations are using mobile. So they are operating mobiles. There is also fast growing middle class, with 60% of the world middle class to be located in Asia by 2030. So there is also inefficient financial and the capital market, creating opportunity for informal alternative. So which is a green area for financial technology growth. Still there is shortage of physical banking infrastructure. Now, no, especially in urban areas, no banks are there. The other is the behavioral issues. People are in Africa and Asia favor of convenience than trust. There is untapped market opportunities. There is 1.2 billion people without bank account. Still, it is an opportunity for growth in financial technology. So there is also flexible protection in the competition. So moreover, there is high fresh graduates in China and India, which are in technological areas. So these all are an opportunity for financial technology growth. When we come to other topic, financial technology and digital economy in my Ethiopia or from other sources. So Ethiopia is also part of this. We are using mobiles, and there is also different reforms underway in Ethiopia for adoption of this financial technology. It is a giving fertile area for agriculture, for hospitality, for transportation, education, and more. So there is a reform takes place in the telecommunication, and still to solve the problem of weak financial inclusion. You have huge numbers of people, young generation without job. So still there is a demand for small scales. So to have kind of inclusive growth, government are putting some initiative which is paving way for a digital strategy for inclusive growth, inclusive prosperity in 2025. So there is a reform in payment system. There is also electronic transaction proclamation underway, which are those are an opportunity for growth of this financial technology in Ethiopia. When we compare Ethiopia with Kenya, the transaction is dominated by cash. So even number of bank account holders are less compared to sub-Saharan Africa. So still this is an opportunity. So finally, the question of today is that regarding this financial technologies, can digital currency replace paper cash or paper currency? So this is highly arguable issues today. So some are saying that it is inevitable digital currencies are going to replace cash. Cash will be dirty financial asset. So our economy is dominated by cash. So still we are teaching in finance, cash is the king. So this cash is becoming under question. So what will be the fate of traditional financial intermediation, banks, even credit rating, because of there is a development of some kind of technology, even recognizing via selfies to give credits. So let me say something quote from the Jack Ma, the founder of CEO of Alibaba, once said that there is two big opportunity in the future financial industry. One is online banking. All financial institutions go online. The other one is internet finance, which is fully led by outsiders. This is my presentation. I thank you all.
Okay, thank you very much. Very good. Okay, let's go on to the next one. Who's up?
Okay, thank you very much. Would you allow me to share my slide? Is that visible now? Yes?
Yes, we can hear you. Yep.
Is that visible?
Oh, can
Not to me.
no, we can't see your slides. Let me
It is still the side of.
there you go. It's fine. Yeah,
Okay.
see now we can see.
Yeah.
Okay.
What about now?
It's fine. Yes, it's good.
Yes.
Okay, thank you very much for allowing me to present a summary of the article Evolution of Fintech, a New Post-Crisis Paradigm. Actually, it is summarized with 3 members, and I will present what is remained, the issue of RegTech and the continuity part of the paper. So, in general, what we have seen from the last presentations or the last 2 presentations related to fintech is most probably starting from the early period to the recent period development of the technology. Hence, now starting from the barter system, trading systems, we are availing ourselves on the cryptocurrency. And I hope in the future, and even now it is already started, we will reach on the platform payment systems. Hence, as it is already mentioned by the previous 2 researchers, this is a simple summary of the fintech evolution with the era, with their geography, what emerged as elements, and their actually origins. So no need of repetition, because we know fintech is no longer the preserve of traditional financial institutions, because we have already passed from traditional financial issues, and even we have avoided the concept of bricks and mortar issues, because we are using the banking systems while we are avoiding the banks, because we do not go to the physical existence of bank. in order to get the service. Hence, as it is already mentioned earlier, the issue of Fintech 1, which is emerged from 86 up to 967, where the issue of Fintech 1, and as it is already said, it is the concept of movement from analog to the digitalization issues. And the second era may be Fintech 2, which is the issue of growth through consolidation, collaboration, and convergence. And most probably, the third era, Fintech 3, is the issue of actually avoiding the BRICS and the mortal issues, where the challenge is raised on the banks. Hence, because of such contexts, we need regulation. We need regulation because challenges are emanating multidimensionally, and even as it is existed on the paper, Fintech 3.5 is available, for instance, for African countries and emerging Asian countries when they are using such concepts for financial inclusions and most probably economic development scenarios. Hence, how the Fintech and most probably the RegTech could be related is actually the Fintech is a reaction to the symptom of global financial crisis, because when we summarize the paper, it is summarized within such contexts. The relation which is written on the paper is the Fintech is actually dealing with reaction of global financial crisis, which is emerged at many times, even in the recent phenomena, global financial crisis, which is emerged because of the failure of assets-backed securities, and even because of the mortgage bubble. Hence, the RegTech maybe most probably it is dealing with providing some solutions for such crisis. Hence, how RegTech could be evaluated. The evolution of RegTech could be seen through three scenarios. The first one is most probably from 1987 up to 2008. You know that 1987 there is a stock crash in US, most probably which is not seen since 1929, the crisis of stock. Hence, we can take this concept as Fintech 1, and its issue is most probably analyzing exchange-based activities. Most probably it is management related to the risk, probably the quantitative risk, that the Basel II demand is. And even we know that Basel II means it is the minimum requirement of capital, not only minimum requirement of capital, but also it demands regulatory supervisions and even the discipline of the market. From global financial crisis onward, Fintech 2, most probably it facilitates compliance. It facilitates compliances and it improves supervisions and regulations. So in the future, looking forward from there, we can assume that we are dealing from know your customer to know your data, because data are increasing from period to period and data may be manipulated. For example, you may take some biometric data that even in the US, a million amount of such data manipulation are emerged. Hence, in the future, we can assume that financial system is on the edge of moving from being based know your customer to the know your data approach. Hence, why we need RegTech? Why we need RegTech? The main issue that demands existence of RegTech is actually increase of compliance costs. The increase in the compliance cost demand from startups, because in the startup businesses, firms may be challenged, for example, because of lack of capital or some other regulatory activities, or supporting regulatory functions, or most probably post-crisis reform, because there is a strong paradigm shift because of such crisis. Hence, those demand is availability of RegTech. Hence, RegTech encompasses some industry and regulators, for example, financial institutions and industries. They are the major drivers or cause of RegTech developments, because there is increment in the compliance demand. There is most probably diversifications of the firms, and when firms are diversified from period to period, they increase the risks, and that risk must be managed well. Some regulators are also emerged and demanded, because when the firm start up and when the technology emerged, it takes time. It takes time for the regulators even to know how it is. This makes the regulators to be the technology neutral. The issue is that the future is uncertain, and even they may wait till the technology will be advanced, so that because of such issue, time lag may emerge. Hence, regulators also exist and demand it. The startups, most probably at the starting up, many business, whether they are financial service or financial institutions or different manufacturing, health, or agricultural issues, because RegTech is applicable in any of issues like financial institutions, health, or agricultural activities, and the likes. Hence, there is a trade of data for market entry, and most probably compliance with the experienced and lean business model or modern business model. Hence, who are the beneficiaries in FinTech and RegTech? Most probably, as per the author's opinion, financial infrastructure, financial institutions, and regulators may be the primary beneficiaries of FinTech and RegTech. Hence, what must be regulated? The big data. Because, as I have said, technologies are emerging and advancing from period to period. Data are increasing from period to period. And the one who is engaging in innovation of data is also increasing, because firms are competing with each other. Hence, we have to regulate the data, because we have said we are marching from know your customer to know your data. Cyber securities, this is actually required because our data are subjected to vulnerable to theft, fraud, attack, and the likes. Microprudential policy, most probably, this affects the economy of country, and countries are interlinked through the technologies, and again it affects the world, hence it must be clearly regulated. So what challenges the regulators? What challenges the regulators? Most probably, many issues challenge the regulators. For instance, the issue of risk management, liquidity, and the profitability. Even we know that liquidity and the profitabilities are running inversely. When liquidity is increasing, the profitability is decreasing, and even balancing this issue may be a very difficult for the regulators, So moving toward this paradigm shift, what must be next? What must be next? We have said that technologies are increasing, diversifying, and innovating from period to period. They are increasing at increasing rates. Hence, regulatory framework must be required, must be demanded. Hence, we know that even when we see the issue of fintech and that of regtech, they are not a subset of another, because they come with each other. Emergence of one thing demands another thing. When technology is emerging, because man by itself is selfish. We need our own benefit at the cost of others. Hence, this demand is regulation, most probably through the technologies. RegTech creates efficiency. RegTech creates the efficiency, and even it plays a critical role in order to enhance or in order to solve the problem of crisis. As I have said, RegTech is actually applicable in environmental issues, in manufacturing issues, in health issues, and others, in addition to that of financial system or financial institutions. Hence, to conclude the author's opinion, today, FinTech 3 is characterized by new competition, and there is a huge diversity. This diversity brought opportunities and risks. Hence, availability of FinTech requires RegTech or technology regulation. Hence, most probably, both of them are working on the digitalization and the datafication of compliance issues, risk management issues, and most probably regulation issues. So when we see most probably the concept of product-based and principle-based, for instance, UK moved from product-based on principle-based or to principle-based. However, China maintained product-based principles, and gradually, sequentially, she have introduced internet finance companies that could be provided for the transactions of small and medium issues, and state-owned for larger transactions. Therefore, in order to benefit consumer and economy, we have to build a new framework that requires a sequenced approach. We are living in the 21st century, where we are actually demanding infrastructures, most probably technological infrastructures. Hence, increment of fintech and regtech are actually supported. supported. Again, we have to regulate the risks, and even while regulating, we have to keep into consideration the issue of market efficiency. And we have to enhance the availability of technologies. For example, though the paper haven't provided such issues, some 21st century development or eras, today we may also have about Fintech 4. For example, you may remember what China and Southeast Asia are using now. For example, WeChat, the Alipay, and the likes. Even the future payment system could be assumed with the chat boxes. For example, we may assume the Facebook or the Google, the Uber, or most probably the Airbnb may enable us to perform such concepts. So this is the paragraph overview of this paper, and three of us demand your suggestion for the future improvement of presentations, because this is actually the starting presentations of seminar. And if still you have some questions, we request you to raise some ideas so that we can share our own ideas with each other. Thank you very much.
Thank you. That was very good. Okay, I have questions. First of all, I think to give my reaction, it was very good. And I love the presentation. And so my first question, let me get my assessment first. I think you did a very good job, and I really like the way that you divided the presentation into different sections, that each presentation had a different focus. And so I appreciated that the first part did the history. The second part went into more depth of what Fintech is and can be. And I really appreciated the last part, which got into the regulation and some of the issues of Fintech 4, because it always evolved. So my first question to the group is, and let me know if you can understand me or not. There's the concept of what we call a cashless society. Cashless society, that we do not need cash. And you talk about this in the concept of Fintech 4 of, Google has, the Apple has Apple Pay, electronic wallet. So the feasibility of an electronic, the feasibility of a cashless society is now very feasible for countries that move quickly to, higher level internet, such as, level 5 and so forth. We talk about it. It is the 4G and 5G. So as we go to 5G internet, we can have a more possible cashless society. So my question is this. It's a question that combines regulation and question, is it a concern for should the regulators be concerned about a cashless society because they lose control of the money supply? So one of the issues of the regulators is that they must control the amount of money in society because there is inflation. And so does Fintech lead to possibly more inflation in the economy? That's the question I have for you, because the regulators are not able to control the quantity of money in the economy. Would someone like to answer that question or take a stab? Or what is your opinion? And I can write the question if I can do it. Let me do it this way. my screen.
Okay.
Go right ahead.
Okay, thank you. So the fourth generation Fintech is going to have some kind of cashless society. That is what was raised in the question. So the issue of inflation, this is a challenge. We are moving from traditional banking system to other transactions are going off banks, means out of banks. Means that even there is the issue of borders. We are going to have global currency. There is a question of having some economists are also, there is the issue of digital currency is inevitable. It's also coming soon. So we have, especially in my presentation, in my part of the presentation, the payment system is so advanced. So we are not using cashes. Rather than we are using different kind of mobile technologies and even via internet connection and so on. As my friend mentioned, that WeChat, Alipay, Alibaba transaction, and so on. In America, different platforms are there. So we are creating cashless societies. Cash is becoming dirty asset. I mentioned it's also a question of discussion. So it is too risky asset. Even it is in we are using cash, as one of my slides have shown that there is Ethiopia is highly dominated in cash transaction, less mobile users. The high unbanked people. Still, this is an opportunity for advancement of more growth of financial technology. Still, I share the question of the instructor. Can we control money supply using this type of technology? Still, I'm afraid to say this. Governments are intervening in the economy. Governments are intervening the economy. For example, in Africa, things are bank-based, not market-based. So banks are mostly owned by states. So state-owned financial institutions, state-owned manufacturing, and so on. So which are dominant. But when we come to their infrastructure and their institutional strengthness, they are weak, they are corrupted. So still the issue of Fintech 2, the Fintech 2 is raising, banks are weak, people's trust on those institutions are deteriorating. So the alternative going to...
Well, I want you to answer my question. My question is about inflation, because now that we have entered a digital currency, and another way to think of my question is the number of transactions and the velocity of the transactions will increase. That is the premise of your presentation, that there will be more and will be faster. So when things are more and faster, more than likely, it will lead to inflation and the inability. So I want you to answer my question. It leads to the inability of the central authorities to control the prices in the country, which can lead to a problem for the population. So for example, let's just take the extreme case. If Fintech leads to an increase of housing prices of 10 to 15% per year, that's a problem. Because now the average salary in Ethiopia cannot buy a house. So the question I have for you, how do we address that? The question is, can we address it? The answer could be no. And if we can address it, how? That's what I want you to answer.
Maybe I will invite my friends. This is very interesting question. Can we control inflation by digital currency and so on. Yeah, that was the question. Yes.
Yes.
I'm afraid to say that still using cashes, inflations are high in Africa. Inflations are high. So that is why we need technology regulations. Maybe let me call Desalegn to react on this. One of the intervention area in this type of innovation is because of controlling the currencies, because of protecting consumers and so on.
Okay. Thank you very much. Actually, to relate your idea to our contexts, you are assuming that cashless society reduces the money supply available in the economy. The issue is that using cashless means we are reducing the crime. We are reducing the crime, but money is revolving across the world. They are revolving in the economy. And even we know that money supply means when high amount of money is injected into the economy or money is supplied in the economy. If there is high supply of money in the economy, we know that there is actually inflation or increment in the price of goods and service at increasing rates. And even you remember the concept of Phillips curve in economics that assumes the inflation by itself is inversely related to that of unemployment. Because cash increased means actually the goods, production of goods can be increased, production of service can be increased. In the same vein, there is high supply of money. In the same vein, there is high employment amounts, or people could be employed. However, cashless society is not an external factor for inflation, because inflation cannot occur because of cashless transaction, because of cashless transactions. The issue is the cash is already available. It is the means or the mechanisms of payment system that we can use either by using the electronic payment system or holding the cash on our hand. If we are holding the cash on our hand, there is actually money supply, high amount of cash is available, but the bank unable to control them.
Okay, let me stop
And
you.
what? Yes.
Question. Are you sure? Are you sure about that? Are you sure about what you just said? Because the amount of inflation in the economy is not only determined by the amount, it's determined by the velocity. It's determined by the velocity of money. It's not about the amount of money, it's determined by the velocity. We go back to very simple models of economics. It says that the GDP is determined by not one variable, but two variables, M times V, money and velocity. And the first time we taught the question, I asked the question to the speaker. I said, okay, let's talk about the quantity. The second time I asked the question, I talked about the velocity. And so the point is that we talk about, it's clear. So you guys did an outstanding job. We need to go on to our other speakers because I know they're anxious. But this is the question I have for you, because there's a research paper here. The very simple research paper is followed by the discovery of what Ms. Kadis did, which is the history. And the history is, what is the impact on the velocity of money, which is easily attainable data from the central bank and the World Bank. And so the point is that the first introduction of technology was the ATM. of the ability of people to use the ATM machine and go and get cash, and then to use a debit card or to use electronic payment. And so you use a very simple categorization of dummy variables to track technology through time on the Ethiopian economy. And you go from Fintech 1 to Fintech 2 to Fintech 3 and document the evolution of technology, and then document how has the velocity of money changed over time attributed to the use of technology. I'd like you to think about that idea. Not that you have to do that, but that is the question that you should think about, because clearly we can agree or disagree, doesn't matter, because we're talking, we just want to talk ideas, but it's very interesting that the use of technology has an impact on velocity, inflation, and the quality of life. The assumption is that it's better. That is a very presumptuous assumption, because in China, you may not be able to buy food if prices go too far. So this is very serious that you may not be able to eat. So I want to thank you for your presentation. You guys did an outstanding job. And let's go on to the second presentation. Who's up? Mr. Germer, are you ready?
Yeah, okay. It's possible to start. My friend will join us.
Okay.
Maybe there is an interruption in town.
Okay, Mr. Mulino, do you want to go instead and to give them time?
Yes, I think we can start.
Okay.
Maskaram, can we start? Maskaram was to take the lead.
Okay, Ms. Maskaram,
Yes.
why don't you go ahead and start?
Yes, I can.
Okay.
Can you see my screen?
Not yet. No. Let me go and let's make sure you can share.
Professor Dennis,
Yes.
my friend is asking you to admit him again.
I will.
May I continue?
Yeah, go ahead. Try.
Can you see my screen?
Not yet.
Yet?
No.
I have displayed.
Okay. Why don't you come back out and go back in?
How about now?
No. I think you go. No.
Yeah.
Can you see me now?
No.
No?
Nope. Try. Let me see if I close some of the stuff out. Let me stop the share and I will. Okay, I think you have to stop your share. You have to say stop share and then share again. Okay, why don't we, Mr. Germer, why don't you go ahead and we'll see if Ms. Meskram can fix her situation. Why don't you, since Mr. Tedeschi's here. Can you guys go ahead and start?
It's possible, I think.
Okay. See if you can do the share. There you go.
Can you see my screen?
Yes.
Okay, thank you. Okay, our title of presentation is Information, Credit Risk, Lending Specialization and Loan Pricing, which is an evidence from the IP financing market. This paper is published in the Journal of Finance Service Research, volume 34, issue 1, August 2009. So the authors is Daniels and Ramirez. So the presenters are Girma and Taye. So this is done under the guidance of Professor Dennis. To begin with, let me tell you the outline. So it has the theoretical background, the methodology, findings, and a little bit critics are given at the end. And finally, we'll let you know a bit about the bankruptcy law in Ethiopia. So to start with about these issues, there are about a number of theoretical researches, but a few empirical research have been done on this issue. And it says that the borrower's information asymmetry, as well as the follow-up or differential screening capacities among the intermediary, induce lending specialization. That means the choice of lender. The borrowers choose the banker or the non-banker. That is the point here. So lending specialization in the private debt market is mainly determined by the borrower's credit quality or risk, but not actually by the information asymmetry consideration. And some authors did research on these issues previously, and they came up with that credit risk or the credit quality has a correlation with the information asymmetry or monitoring activity as documented by some authors. So it is giving an opportunity to see if the lending specialization is a function of credit risk and information asymmetry. Again, other researchers like the Hoswald and Markowitz in 2003, they argued that information consideration jointly determine the degree of lender competition in the market, as well as the pricing for the financial instruments. And some other extent workers are also came up with these researches, but they try to see differently the lender's choice as well as the loan pricing decision. So on the basis of this fact, this paper tried to explore the issue by empirically testing the theory of lender specialization in an environment that leads to uniform credit quality. That's actually in the DIP finance market. DIP means debtor imposition. That is, the debtor still can control the assets of the company even after bankruptcy, but after filing to the court to get protection from the creditors against calling for bankruptcy, they may get finance to still be in operation if they can keep payroll and balance sheet, suppliers, and the like. So that the IP financing market has its own impact on the credit risk of the investors, of the borrowers. So this allows for a critical testing of whether lending specialization in the bank is attributed to the credit risk or the information consideration or the information asymmetry or the information opacity of the borrower. And secondly, what this paper tries to investigate is the choice of lender and the determinant of loan pricing. And this is basically allow for testing of the effect of lenders' differential monitoring, information handling capacity, and lending specialization on loan pricing. So to see these pointers, let us see what in the environment as well as the potential effect of DIP financing market on the credit risk. DIP, as I said it minutes ago, it means debtor imposition. So debtor imposition financing market refers to a market where the debtors or the original equity holder of the business can get finance after filing protection to the court to get protection from the creditors calling for a bankruptcy. So, or we can say that this is simply for financial distress firms that tries to restructure its operation under the Chapter 11 of the bankruptcy, which may enable them to get finance to stay in operation. As we know that for a bankrupted company, getting finance is very difficult. But the intervention of the bankruptcy court and the provision of section of 364 of the Bankruptcy Reform Act of 1978 make it easy for companies which is already bankrupted to get finance and keep its operation. Here, the DIP financing market, so that represents an excellent opportunity to analyze lending specialization, means the choice of lender and the pricing of loan in the corporate credit market. So firstly, because the most important thing is the lenders after bankruptcy can get the place of a senior lenders or super priority, meaning that even if they finance the company post bankruptcy, the court will give them a chance to get their money in full, even in the event of liquidation, before the pre-lenders get anything. So that the super priority status allows a DIP loan to have payment priority over unsecured pre-petition debt and administrative expenses. And actually, this is paid within the reorganization plan or maybe in the process. So the DIP loan also carries extensive covenant like the negative pledges, also called negative covenant. This means that the negative covenant restricts the borrower to use the asset to get any other loan by taking it as the collateral. By doing so, it could jeopardize the lender's security. So that this negative pledge or negative covenant may give the lenders maybe a better security than the conventional collateral in the previous law. So the aspect of DIP financing create an environment where the credit risk of the borrowers can be considered uniform, meaning that whether the credit quality of the borrowers may be different, in the DIP financing market, where the bankruptcy court involved, you can see no more cross-sectional variability in the credit risk, so that all companies under the bankruptcy situation are considered uniform. So there is a probability of default, which is not inevitable. It could happen, but still there is a probability of recovery. And this is even in the event of liquidation of the DIP firm. And the second thing is the DIP loan represents a very homogeneous sample of corporate revolving loan. Why? Because the DIP loans are mostly for short period of time, which are basically used to finance the working capital or the short-term financing need of the DIP firm, so that they will be paid shortly before the reorganization plan is confirmed or implemented. So we can say that they are more secured. Thirdly, the renegotiation effectiveness. In the DIP loan, since they are not, they are commitment by private lenders, issued only under bankruptcy court supervision. So you can't confront with any kind of agency problem that's alluded to the contracting literature are not likely to exist. And there is no possibility of misallocation or diversion of the resources. There is no under or overinvestment, as it is supervised and authorized by the bankruptcy court. And finally, firms in the Chapter 11 of the bankruptcy are assumed and believed to be highly levered firms. So in a highly levered firm, we know that the risk of credit is higher. So this presents an excellent opportunity to test the robustness of assertion that is credit risk determines the choice of lender. So based on these evidences, the paper hypothesizes the following. And the hypotheses can be seen from the two perspectives. The first one is from the choice of lender. And the second one is the loan pricing. So from the choice of lender, the first thing is regarding the information-induced lending specialization. Here, the hypothesis one says the lending characteristics or the profile of banks is significantly different from that of the finance companies. The reason is that banks do have a good position to get access, monitor, and process the information of these borrowers. Basically, these borrowers open saving checking account in them, so they can easily look and evaluate the credit quality of this borrower. And the availability of the information technology this time helps the bank to get much more information about the borrower. That's why banks are in a better position that may be obtained as a result of their depository role rather than the non-bank intermediaries. So the second hypothesis is banks are more likely to lend to large borrowers than to the small borrowers, unlike that of the financial companies. Again, the reason that is given for this information is that large companies do have a well-developed reputation. They may have much more data and are believed to have a stable cash flow. And mostly, they have access to the capital market. So from this, we can see that there is much information can be accessible for this company, because they can file tax returns, anything to the SEC. They provide a news wire, and the company ratings may be given for this company, so that there is a much more information available for large companies. Actually, this point is related to the information asymmetry, or the transparency, the information transparency of the borrower. There is no actually agreed upon measurement for information opacity, but most authors try to measure information transparency of the borrower using the size of firms. So as firms becomes large in size, then it is believed that the company has a potential to repay principal as well as interest, so that banks are willing to lend their money to these big or large size companies instead of the smaller company. Regarding the credit risk, again, induced lending specialization. So the point here is that lending specialization is the function of credit risk. Actually, we are talking about the DIP financing market, where the repayment guarantee is given by the bankruptcy court. So that credit risk has nothing to do with lending specialization. So the hypothesis is based on that. The credit risk measurement are not significant determinants of the choice of lender because of the DIP financing market. And the other hypothesis, which is connected with the loan pricing. Here, credit risks are there. So for this, the bankers or the lenders has to be compensated. So we have to incorporate the credit risk in the loan pricing. But depending on the size of the firm, the information asymmetry and the other thing, the pricing can be different. So this hypothesis 4 says the IP loan made by bankers carry lower firms because one, they prefer to lend their money to large company. Second, they can have an access to more information about the borrower so that they can charge lower spread or price for these companies, whereas the non-bankers do the reverse or maybe the opposite. So to do the research, sample data were taken and the data have been collected. Actually, the data are obtained from, for DIP loans are obtained from Delscan, which is a database of loans of large finance constructed by Reuters Loan Pricing Corporation. So this company contains information for most large publicly traded firms, but as reported by some Carely and its co-authors, says it covers a significant fraction of dollar amount of outstanding customer and industrial loan. So that this deal scan is often used because it contains an extensive amount of information that is basically required for the research purpose about the characteristics of the individual borrower, the loan amount, as well as the lender's characteristics. So 970 DIP transactions were found from the period 1988 to 2004, which includes multiple DIP loans by the same company. So the drawn all-in spread is the measure of the overall cost of DIP loan. And in all-in spread is defined in Delscan as the sum of coupon spread, annual fees, and upfront fees expressed as the markup over the London interbank rate. So that after requiring that the transaction have been complete set of data for the regression analysis, the final sample is comprised of 550 of the DIP loans were taken. And finally, out of the 951, the research dropped 490 transactions because these transactions were made by the same companies over and over again. So it is possible to look just one-time transaction for this company. As a result, 419 transactions were omitted from the sample. But to see the effect, whether these omitted samples do have some significant effect on the result, a robust check have been done. But finally, it is found that no significant difference between the result of the omission of this sample size. So it is unlikely that the result provided in this paper are affected by the sample filters. And when I come to the descriptive statistics presentation, So an information regarding the DIP lending markets are given in the first session. So the sample description, like a brief description of the sample used in this study. So in table 1, we can see that the distribution of DIP loans over time and across industries. So this information is presented in 2 panels. Panel A is about the market for DIP has significantly grown from 5 loans totaling in 1988, which is account about $320 million, and grows to 66 loans, and that a total of $15.3 billion in 2004, with reaches a peak in 2002, which reported about $23.1 billion. So to show you, let me go to the table. So I think it's visible for you. Can I proceed? Is that visible, or can I make it full screen?
Sure, go ahead. Yeah.
Let us
It's
visible.
Okay, this is the first panel, which shows the distribution of DIP loan over time. So in the first column, you can see the years from 1988 to 2004 up to 2004, and the second column is about the number of DIP loans. So in 1988, there are only 5 number of DIP loans were taken, and during that time, a total of $320 million were outstanding loans reported and obtained from the database. Out of these 320, the 5 DIP loans accounts about 0.91%. Each DIP loans may have an average of $64 million. But as you can see from the table, as you go down through the years, the number of DIP loans increases. And as the last 2004 report shows, about 66 DIP loans are reported. And the total amount of loans, again, grow over years. And the last column, the S, all in a spread, shows the amount that a borrower pays over the LIBOR, the London Interbank Exchange. And the second table shows you the distribution of DIP loans by industry. And as you see in the first column, there are a number of industries: mining, construction, manufacturing, and the like. So for these companies, the number of DIP loans taken over these years is, for the mining company, 6. For manufacturing is about 230. For retail companies, about 151. So these 2 sectors or industries can take the largest share of the DIP loans. And as you can see from the mean amount of loans taken by these companies, for the mining companies, 150,000. But for the telecom is about 498,000. And the other information is about the borrower size effect in the DIP lending. So borrowers are partitioned into 3 equally ranked groups based on their sales. We can, it is classified as small, medium, and large firm sizes. If it is visible, okay, let me just make it full screen. So I think it's visible now. So based on their size, as you can see in the up on the top, small, medium, large, and all together have been presented. So in the contract characteristics, you can see the facility size means the amount of loan that is taken by these small, medium, and large firms. So for small firm, about $56.5 million were taken or obtained from the lenders. The medium-sized businesses took about $114.56 million. And for the large companies, $367.14 million. So the share of this money is grown and larger for large companies, as you can see here from the table. The maturity of these loans is relatively equal from all sides of the businesses. Regarding the draw, all in spread, the amount is lower for medium and large companies. The justification is that as businesses are large in size, they are trusted to pay back the money for the lender, so that as the risks are lower, these lenders will charge them lesser amount. As a result, for small companies, the all-in spread is higher, about 420. For the medium and large is a bit smaller when it is compared. But the fractions indicated, again, is larger for all companies, but relatively for small companies, about 69%. When I take you to the second category of information about borrower's characteristics, or the information transparency of the borrower, we can measure using different ratios. So the leverage ratio is for all of these companies is more than 90%, which is still supports the empirical finding by different authors, because banks, those in the bankruptcy, are largely levered firms. So this tells us that a large portion of their assets were financed from the lending. That DIP loan amount to total liability is 54, 28, and 20%. And again, you can see sales to total asset, PPE to total asset ratios. Regarding the lender characteristics, here we can see that both banks and the finance companies provide lending to these companies. So for small company, as you can see here, 39% of the total loan were obtained from the finance companies, whereas 29 and 15% for medium and large companies, respectively. And the number of lenders, when it is compared for small, medium, and large, the number of lenders for small company is 2, for medium company is 4, for large company is 6. That means the total amount that is when it is taken as a fraction, so more number of lenders are willing to lend for the large companies, but a few lenders are making loan to these small companies. So here, the lender characteristics in the DIP lending market, as extant research shows, that the type of lender, the size, and the ability to more efficient monitor the borrower are important determinants of credit quality. And the pricing, in particular for the corporate revolving credit market. So authors classify these lenders as bankers, non-bankers, large and small lenders. But the extant literature hypothesized that banks are unique in monitoring. The reason they just the put is, this is because banks are able to gain information advantage. So the type of lenders through checking account that in turn are used to control or verify the account receivables, the investors, and the like, when it is compared with other kinds of lenders. So an increase in the bank's capacity led to an increase in the bank's information accessibility, and that will give them an advantage over the others. So large lenders are more likely to lead to the front on technological, like the sophisticated credit scoring system, the data processing, and the like. From this point onwards, let me invite my friend, Taye. So I will leave the stage for him. So he will present the remaining parts of the chapter.
Thank you, Gurma. Just please allow me to share my slide.
Okay, you can proceed now.
Okay, can you see it?
Yes.
Okay, thank you. I will continue from where my friend just stopped. Thank you very much, my professor, just to give me this chance to present on the information, credit risk, lending specialization, and the loan pricing. I'm going to present just the parts related to the econometric model results in general next to the descriptive statistics. Okay, having this as it is discussed in the methodological part, in addition to the sample described, different models, just especially the ordinary least squares and the two-stage least squares models applied in this case in order to just avoid, especially for the self-selective biasness. So in this case, the multivariate analysis indicates the model for lender choice and the data imposition loan pricing. Typically, in lender's choice model, the decision is just the function of a set of just borrowers' observable risk, the information proxies, a set of time and industry control just variables as it is supported by different authors here. In a typical loan pricing model, loan spreads are a function of a set of loan and just the borrower's characteristics, like that what we call like observable risk and information effects in general. The choice of lender and loan pricing are interrelated. They are interrelated. So to overcome this problem, selectivity bias problem, authors, just my professor and his friend used two-stage least square developed by the Heckman model 1979 for the data imposition loan pricing model resulting in this case. So these are the model for lender's choice model and the DIP loan pricing model in general. Li star is equal to the beta 1 times di minus the random disturbance term, and the pricing model, loan pricing model is given as beta 4 times x plus n lambda. So in general, Li represents just equal to 1 if the latent variable, that's Li greater than 0 and Li is equal to 0 if the latent variable Li is unobservable benefits from the lender's decision to lend. Therefore, just the loan pricing model for the data imposition is observed drawn in all spread measured by the IS, and xi is a vector for variables determining the loan pricing in general. So the epsilon and the mu represents the distributed disturbances. So the empirical results of this study First, the lender's choice model. The lender's choice model, the functional form of the lender's choice decision equation is just given about, we do have about 18 variables here as there. Just so based on this, here the banks are considered the dependent variable, that the dummy variable given to say that the lenders are either the banks or non-bankers, the banks and the non-bankers. The size of the bank that given us, they are just given us dummy. This dummy large or not, the number of just the lenders, the dummy if they are syndicated or non-syndicated, the given just the top, the rank of the lenders, if they are the top 25s, given the Hender files, the here the logo of the sales, the in general, the property, plant, equipment to the total assets, the cash flow to the sales, the account receivable to the intangible assets, the leverage that the totally to the total assets, the DIP leverage, the rating, just if they are rated, yes, and if they are not rated, just given us the dummy variables, the size, the maturity, and so on. These are the variables to be included in order to check the lender's choice model. As we said that the dependent variable that the lender considered as a dummy variable, whether it is just a bank or non-bank, like finance companies, the insurance companies, and others, and so on. So it captures the choice of the lender or lending specialization. Authors use this to indicate the bankers, the bank versus non-bank lenders, because overwhelmingly most of the large lenders are likely to just bankers in this case. So D is given 1 if the lender is bank, otherwise if it is non-bank, just given 0 value. Now, in this case, as we have hypothesized, as my friend discussed, the first one in relation to the lending specialization, the first hypothesis says that lending characteristics or profile of banks significantly different from that of the other non-banks that finance companies in general. To test this hypothesis, authors used variables like the size of the lender, that's considered as dummy, the number of lenders, the syndication, if the lenders are syndicated, yes, or not, they are considered as dummy variable, an indication of the top 25 lender, lead arranger, and the final just index of the lender are some of the variables that used in this case in order to check just the lender, the lending specialization. What is the result from this regression? The lending characteristics of banks are significantly different than those non-bank lenders. They do have just, they are significantly different. Large lenders are associated with banks capturing the bank's information processing ability, and the top 25 lead arrangers are less likely to be the bank on this just model. Banks are more lenders in this case in their syndicator to handle the information asymmetries of the late imposition loans. Most of, in this case, banks are more mostly the lenders, and they are just syndicated in this case than the non-banks or finance companies. Syndication is also more often found in banks than non-bank lenders, and these banks are more dependent upon the syndicate structure to handle the information asymmetries general. So banks are relative to the non-bank lenders use syndicate with greater the greater lead lender concentration. So this is consistent with other just previous researchers with a view lending specialization may induced by the lender characteristics. The second hypothesis is about banks are more likely to lend to large borrowers and non-bank companies like let it be just finance companies, insurance companies are more likely to lend to the smaller borrowers. To test this hypothesis, authors used variables like log of sales to measure the firm size as a proxy of the asymmetric information or opacity of the firm, the ratio of the property, plant equipment to the total assets. This is a proxy for information as tangible assets. Just may capture the firm's degree of assets openness, the ratio of cash flows, the sales, the DIP firms are already in bankruptcy, the account receivables plus inventory divided by the total assets. Having this, just by using these variables, authors just arrived at the results of the significant relationship between just the measure of information opacity and the type of lender observed. The coefficient of log of sales is significant at 5% level. At 5% level, because this is one of the variables that used in this case in order to check the hypothesis are. And the coefficients of the property, plant equipment to the total assets, the cash flow to sales, the account receivable to the inventory over the total assets are not significant in this case. They are not significant. Then this suggests that the two variables just are not able to capture any additional information that effect is beyond this just captured by the log of sale. The other, the result is provides support to the view of there exists lending specialization in private markets, bank versus non-bank lenders based on the information consideration. Banks have greater propensity to lend to large borrowers, as large firms are in general more transparent in order to avoid the information asymmetry, likely to borrow from the bank because they do have trust in this case, as my friend also discussed in the descriptive statistics just before summing. The non-bank lenders have a greater propensity to lend to small borrowers in general, according to the results checked by the author. The other issue is regarding the credit risk induced lending specialization. The third hypothesis, as hypothesized before, credit risk measures are not significant determinants of the choice of lender, meaning bank or non-bank lender to the DIP borrowers. Traditionally, credit risk is measured with credit ratings and or leverage ratios most of the time. Authors used three variables to test this hypothesis to capture the role of the credit risk on lending specialization in the data imposition market. These are the rating that's considered as a demi variable, given d is equal to 1 if the firm has a rating, otherwise 1 if the firm is not just given a rating. The other issue, the other variable is totally to the total assets, that's leverage ratio in this case, which is a proxy to measure that traditional risk measure. DIP2, the leverage, investigated just the impact of the non-traditional credit risk measure, which is DIP loan to the amount divided by the total liabilities in this case. Having these variables on the basis of the third hypothesis, authors arrived at the results The coefficients for the leverage ratio and the rating of company which is given as a demi variable are not significant at 5%. This suggests that there is no credit segmentation in general in just rating. The coefficients of the DIP to the leverage ratio also, which is given in this case as a variable, not significant at 5%, just of level of significance. This confirms that the absence of credit risk segmentation. The last point is the issue of the second objective of this paper, that is the loan pricing model. These loan spreads measured by the drawn, that's all in spread, represents the observed component of the price of the DIP loan. What is the cost if just data in possession is just given? These are about, as you observe that, about 18 variables are used in this case: the lambda, the HI Herzfeld index, the log of just the sales, the property, plant, equipment, the cash flow to the sales, account receivable to the intangible assets. These all, some just as you observe, these variables are used in checking the loan pricing model. The fourth hypothesis based on the loan pricing model is about the determinants of loan interest rates. The fourth hypothesis indicates that the DIP loans made by the banks carry lower fees. DIP loans made by the banks carry lower fees than DIP loans made by non-banks. Then the results in this case indicates that just about 4 panels are there in this case. On the result of the table result indicates results from panel 1 shows that the type of lender has an impact on the data reposition drawn on the cost or loan pricing that's measured by all just in a spread, as indicated by the negative and significant relationship on the coefficients for the lambda at 5% of level of significance. If the DIP loan is made by the bank, the drawn or in spread just on the loan is about 28.74 basis points lower than that if it was made by non-bank lender in this case. And it supports the fourth hypothesis that just the DIP loan by banks is lower fees than non-banks, and it confirms the hypothesis. The coefficients for the cash flow to the sales and the property, plant and equipment to the total assets are negative and significant at 5% of level of significance. In this case, both variables are a measure of just firmness asymmetric information and the significant negative coefficient. And this suggests that the firmness information opacity contributes to the DIP loan pricing in economically significant manner in general. The non-traditional credit risk measure that DIP to the leverage ratio is positive and is significant. Again, it is significant at 5% of just level of significance. The other issue in relation to the OLS results, the OLS regression in panel 3 and panel 4 based on the bank and the non-bank samples. HOLS regression on estimates of the data reposition loan pricing model for the size of the lender and the size of the lender, which is just given as large or not, given as demi variable. The coefficient on this variable, on the demi variable, regarding the size of the lender is not significant at 5% of level of significance. And this provides that the evidence banks possess unique information about the borrowers that allows them to lend at a comparative advantage. In short, borrowers obtain significantly lower borrowing costs from different information processing capabilities of just banks. Having this all about the paper, let's put our just views as critics. Of course, just we have identified points of review for this paper. The title of article, it is precise, it is clear, catchy and informative title. We got just this title in such a way. The abstract of the study, it is clear and well articulated, and the general concept regarding the topic and the whole paper just included in this case. The background of study, it is properly stated and just adequate empirical and theoretical just issues associated with this background in general to the literature. The problem statement, it is clearly just identified that. And regarding of course, regarding the research question, we couldn't give the separate section for the research question, but since there is the objective that clearly indicated, as my friend just presented before, it's adequate. And the other issue regarding the literature reviews, adequate both theoretical literatures and the empirical literatures reviewed properly, and just it's more adequate. The conceptual framework, of course, we could get the conceptual framework paper, which is a model for even the data analysis regarding the methodologies, the source of data, the sample, the just econometric models to be applied are clearly just indicated. The analysis, it is, we reviewed that it is in relation to the objective and the literature that associated with the paper, and it is just very, very adequate. The references, in this case, just proper references in text, and just the reference lists are associated with these papers. These all are our views regarding the paper. Having this, let me give you, because it's part of our assignments, about bankruptcy law in Ethiopia. Okay, the commercial code of, because our professor just raised the question of just the existence of bankruptcy act in Ethiopia. So there is bankruptcy act just in Ethiopia, or there is bankruptcy law. It is part of the commercial code of Ethiopia, which came to effect in 1960s. Just it is more than half of the century, and the main source of the Ethiopian bankruptcy regime in this case. Although the regime has been just enforced for over half of the century, its underlying theories have remained intact despite the makeover they have undergone due to the dynamism of the commerce. Bankruptcy in Ethiopia is governed by the fifth book, that, as we say, by commercial code that enacted in 1960, and the scope of the application of the bankruptcy legal regime covers any trader as defined in Article 5 of the commercial code, and any commercial business organization excludes, which excludes the joint ventures in this case from the business organizations. Okay. Commercial business organizations are listed in this commercial code of Ethiopia, which is part in which the bankruptcy act is just part. The private limited companies, limited by shares, limited liability partnership, general partnership are part of the commercial business organizations. The insolvency of the public companies differs from the insolvency of their private counterparties due to special features of the public companies. The public enterprises, which is different from that of the private companies and just their insolvency. Of course, this word is used in substitute of the bankruptcy, and which is different from that of the private business companies. Such features given to these differences for private and the public enterprises are due to their establishment by the regulation rather than memorandum of associations, the determination of their just composition by the board and the special law, rather than by commercial law, their state's ownership rather than the private just ownership. This made them to just be different in solvency of the public enterprises and the private companies in general. The bankruptcy can be instituted by the way of petition made by, in order to just be insolvent or to declare bankruptcy. It's instituted by just the petition made by the debtor, one or more of the creditors, the public prosecutor, or the court itself can institute just initiate the bankruptcy in this case. The competent courts may declare bankruptcy of a company if there is just a suspension payment. A company is no longer able to meet its just commitments, which is related to the objective of its establishment, which is the commercial activities. Then the factual declaration of bankruptcy without the court judgment has no legal effect in Ethiopian context, as the commercial code of Ethiopia or the commercial law just indicates. There should be a declaration by the court. Without court judgment, there's no just bankruptcy declaration. It's not just in effect. There is no provision for discharging in Ethiopian just bankruptcy law in this case. A bankruptcy proceeding cannot be closed and the debtor is not just restored or restructured to his or her full rights unless the debtor proves two just major criteria. These are all creditors who have proved claims have been paid, the trustees have been just deposited with adequate amount of amount to pay all just creditors. It is just if these two major issues fulfilled, yes, we can say that the bankruptcy proceeding just are to be just closed. Okay, this is some informative points about the Bankruptcy Act in Ethiopian context. Thank you just for your time, and you can raise this all are just all my and my friend's presentation on our just article.
Okay, thank you very much. That's very good. Okay, that was well done. Both of you guys did very great on that. And, you know, I say, so we're a little short on time here. I want to give respect to our two last participants. Let's go to them first, see how they're feeling here before I go to see if we have any questions. So, Mr. Muller, I guess the question is, do we have time to continue for another 45 minutes, or do you want to postpone to Tuesday? Ms. Meshkram, do you want to postpone, or do you like to go ahead and present now?
I think postponing is better, sir.
Okay.
In the interest of time.
Okay, so we'll postpone. You guys will lead us off on Tuesday, okay?
Okay, Dr. Daniel.
Okay, I apologize. You know, I tried to be respectful and let people speak freely today, because the first time, you know, we also give you the same respect. We'll give you the full amount of time to do your presentation, so you have no time limit. And so, but after these presentations, we will try to be a little bit more, because that is a factor when you present this timing. You know, we're allocated time, and we'll make sure that we. I want to appreciate the presentation today. They were all fantastic. But I do want to pose a couple of questions to Mr. Germa and to Tedeschi. And so I guess the question to the journal, do you see any potential for a research project, bankruptcy, in Ethiopia as of interest or of any value, or is the data? I guess the question we want to ask the class, is there any research potential here in terms of a debtor in possession paper or bankruptcy paper in Ethiopia, or is the area too difficult to collect the data? I don't know if you understand the question. So the question is, can you hear me, Mr. Germer?
Yes, Professor.
So the question is there a research paper? Is this a valid area of research? Bankruptcy in Ethiopia, is it a valid area of research, or is the area too difficult because the data is not available? What is your opinion?
Yeah.
That's a question. I'm asking
Okay,
you.
may I reflect?
Go ahead.
Doctor?
Go ahead. Yeah.
Okay, thank you. I got your question. Of course, just this type of paper is new for us, even just for the students. Till now, we couldn't get the paper just that performed on the bankruptcy just issues, because of course, we don't have organized database which indicates the bankrupted just companies even in Ethiopia, unless some informations are searched for specific companies or to the just or the I think to the Chamber of Commerce in Ethiopia. Just there is what we call the Chamber of Commerce, who controls about the just trade activities in addition to the Ministry of Trade. But we don't have such paper till now, especially even we couldn't hear any single paper which just conducted on such topic.
Yeah. Okay, what about for banks? Because this is a very popular area for banks in terms of banks that go into reorganization, banks that go bankrupt. It's the same idea. And there should be an interest in whether the banking sector is has bankruptcy or not. I'm not familiar with the area. Is it possible to application to banking?
Okay, good. Till now, just even in our age, or just in even the banking history in Ethiopia, we couldn't, I think, if I'm not mistaken, my friends may just help me if they have just information. I couldn't see any single literature which indicates the bankrupted bank in Ethiopian context, unless they are restructured or just merged with some banks, or unless there is a nationalization in Ethiopian context before, I think, before 1991 Gregorian calendar, there was a nationalization of the private bankers to the to control under the government because of the economic policy. Other than this, we couldn't hear any bankrupted bank or just insurance companies in Ethiopian context. That there is a regulation regarding the bankruptcy if it takes place just in Ethiopian context by the National Bank of Ethiopia, that the regulator, which is in line with the Commercial Code of Ethiopia's just bankruptcy law.
Okay, so now last question about this whole thing of super priority status. So in Ethiopia, no super priority status exists in terms of putting one lender ahead of the other lenders. Is that true? There's no ordering effect. Mr. Germer?
Yeah. Okay.
Yeah. Mr. Germer, you go first.
Okay. Actually, there is a hierarchy, maybe rank in putting or placing the creditors, the lenders. Those who may have lent their money, having or asking with the collateral, are placed first. And there may be some lenders which may take a partial collateral in some kinds of unsecured loans as well provided to the borrower. So the priority is based on the securities. So secured loans are paid in full first, then a partial secured loans may follow, and lastly, unsecured loans will be paid. But in the time of bankruptcy, I never heard of a situation in which bankrupted company may allow to finance its operation after declaring bankruptcy. So it's all about the prior state or before the bankruptcy of a company that the borrowers may be ranked based on the security.
Thank you. Okay, I want everyone to keep that concept in mind for next week when we talk about corporate finance, because we're going to cover a topic called exit consent. And under exit consent, it leads to what we call a reorganization of the debt to refinance the company and to change the leverage ratio of the company. And so next week, we'll talk about corporate finance. We talk about corporate finance theory. We talk about Modigliani and Miller. But the whole point of exit consent is to resolve something called the holdout problem. And in this case, we're talking about a type of debt financing of allowing to replace the debt. It's a debt replacement strategy. And so I will present that paper probably Monday. I actually won't present it. I'm going to give it to somebody to present, but I will talk about the concept of what's called the holdout problem. And if the holdout problem, we're trying to see if we can change the financial slack of the company, because for some reason, the financial slack of the company has become tight. But we also have our first presentation by Ms. Bogali, Mr. Moore. We're looking forward to, again, I apologize for today. I want to thank you for your time today. I think everyone did an excellent job. I want to congratulate you.
Okay.
Now, if you could, I'd like you to make your.
Shall I? Professor.
Can I make one point? I'll make one point and then I'll let you speak. If you could make your presentation. If you could make your presentation available to your colleagues.
Okay.
So you either could share it directly, but if you would email it to me, and then I will post it on some type of site that everyone can access it. So therefore, everyone has access to the information. So go ahead. You have questions? Go ahead.
Yeah. I was thinking about the question you raised.
Yep. Go ahead.
It was, it was destroying my mind, actually. The relationship between the inflation and the digital currency.
Yeah.
I was trying to find that inflation is all about the high supply of money in the market. So even there is governments to finance their deficits. So, for example, in America, to bail out the problem of COVID, there are more printing of money. So it's put more pressure on inflation. So increase inflation. So the cash base is increasing more inflation than. So Bitcoin, like digital currency, cryptocurrencies are becoming some kind of protection against this type of inflation. So there is an argument that inflation can be controlled by digital currency. There is also another, how we control that. So I wanted to know more about that. Can you say something about this, the question of
it's a very interesting area of research, but the question is, causality. The causality is that it does, for example, we know that the as you mentioned eloquently, the value of Bitcoin is that it cannot be devalued by inflation because there's only a fixed supply, correct? But that is the value of the currency. The value of the currency cannot be devalued. That's not exactly inflation, because inflation is the prices of goods and services in the economy. So we have to be clear about what we're talking about here. So the value of the dollar, is impacted by inflation. So if inflation goes rampant, the value of the dollar is devalued. Bitcoin is a protection against that because the fixed supply assures that actually the supply goes down, that it has a value increasing function to it, correct? That is different than the overall price inflation in the economy, which is the price of goods and services. And so there's two different questions there. Then there's also a question of causality of, does inflation have an impact on velocity and vice versa, which is more complicated. But I think we have to start with a simpler question first, which I was proposing to you, was that the way to look at this is that as technology changes, what happens to the velocity of money? That's a very simple question, which can be analyzed. So when you start to do research questions, we can't talk about the complicated, as you stated, it's a very complicated question. But we cannot attack the complicated question given the data that we have. We have to start with a very simple question. And as Ms. Kadis pointed out, I think as you go from Fintech 1 to Fintech 2 to Fintech 3 to Fintech 4, that's a nice way to categorize changes in technology. So that problem is solved. If you can, now it's about correlation. Can you correlate that to the velocity of money, which is very easy to calculate? And then the third question is, can you correlate that to inflation? Those are three very easy data points to get. And then once you get those data points, then you can talk about your question, which is the value of the currency. So I break it down into part 1, part 2, part 3, part 4. I don't know if that makes sense to you.
Maybe, Professor?
Yeah.
This is Mulena speaking. It was striking that you raised about an issue of bankruptcy in Ethiopia, Ethiopian banks.
Yeah.
I was thinking of, Taye was saying that in the Ethiopian history, we never came across bankruptcy of any financial institution for that matter.
Mm-hmm.
But the issue, I think, is, most of the financial institutions in Ethiopia are very highly regulated. It's the most regulated sector, like it is the case in all countries.
Mm-hmm.
But the regulation mainly, focuses on books of accounts.
Right. Mm-hmm.
Books of accounts. And probably, we couldn't, we are not able to witness the financial distress of the banks, really, because we don't have capital markets in Ethiopia,
Right.
where the actual money value, where the actual asset value of banks is not measured.
Agreed.
So particularly this would be related to the topic that we are going to present. Birma, can you mute?
Okay.
Okay, may I continue, sir?
Yes.
It is related to the topic that we are going to present next time, probably, where the control, the regulation should be based on, the market value of the assets. And very recently, I see that some international banks are not very keen to operate with Ethiopian banks because of this foreign currency problem. Mm-hmm. And the capacity of banks to pay letter of credits even. So if we really go down into the financial capacity of the banks in terms of market value, probably they are moving towards a distress. And I think that could be of a good point of research, probably one. And secondly, we have to think of bank rating companies. We don't have bank rating companies in Ethiopia. Banks are not ranked, they are not rated. So the fact that we didn't face bankruptcy probably is because of the fact that our financial system is not earmarked to market, rather it is basing on book values. So that still probably we may be moving towards the journey of financial distress.
Yeah, I understand your point, but I think it still is an open question that I think we can find out whether there is market values through different markets. We will talk about this next week. So the first thing I would say is that in America, we had a very similar experience with something called savings and loan institutions that was highly regulated. So therefore there were not market values. And so therefore, because they were regulated, they were allowed to stay open even though they were bad companies. And we call them zombie banks. And so, you have something similar there, that just because something is alive does not mean that it's good. So be careful of kissing the zombie, right? So we'll talk about this next week because we're going to talk about something called the credit default swap, CDS. And we're going to talk about the debt market. So even though we don't know the market value, there's no equity market, my guess is that there is a substantial debt market in Ethiopia. And that debt
banking system.
Huh?
Just the banking system.
That's right, debt for bank, right. There is substantial debt for the banking system. And if we can find out what is the book value of that debt, let's just say we can get the book value. If we can get the book value of that debt and kind of see how that book value compares to other countries or so forth, I even believe that probably in Ethiopia, there is some CDS. I bet you there are credit default swaps in Ethiopia. That's a very interesting question. If there is credit default swap in Ethiopia, that means that there are, and it might only be for one or two banks, for the largest ones. If we can find out the credit default swap in Ethiopia and see how that responds to the economy, that would be interesting in and of itself, because it would imply that there's some type of market mechanism developing. It's at the initial phases, and that it can be exploited. Because, for example, if the regulators did if they did one simple thing, they say, look, in order to be a bank in Ethiopia, you must issue a credit default swap. That would give you an immediate market signal. It's not complicated, it'd be very easy. You make the banks become a membership of an association. They become a membership of it's called the Syndicated Loan Association. You make every bank issue one syndicated loan. And as every bank issued that one syndicated loan, then the private sector will issue a credit default swap. And that would give you an immediate monitoring system. And that's what the Federal Reserve did in the United States. When we had the bankruptcy in 2008, they took over all the major banks, but they made all banks and investment companies become your topic, large financial institutions, LFIs. Once you have an LFI, you must have a credit default. You now have a CDS because you're a large complex. So this is a very interesting question because it does not have to be an empirical paper. It could be a literature review, a survey review that says this is how you implement a market monitoring system in Ethiopia. And that's very valuable, right? You say, okay, we don't have markets, but we can move toward markets in a very simple and sophisticated way that adds value to the economy. And that could be a research paper or a dissertation. I don't know if you agree or not. Interesting, right?
I do agree, sure.
Okay. May I add one thing, Dr. Daniels?
Yeah, sure.
Okay, thank you. It is just for your information. Mr. Muliner raised one thing. Just Ethiopian banks are highly regulated. Of course, just they are highly regulated.
Yes.
Not only because of the regulation by just the National Bank of Ethiopia, the government also just not allowed to enter or to invest in banking business for international banks, or other foreign banks are not allowed to just invest in Ethiopia. Not only in banks, in finance industry, it is locked for just other international finance industries in general. That is the reason why we are not just directly connected to the financial crisis in 2007-8, just and the crisis before in 1990s also. So almost we are just free to some extent, since there is no direct connection with this banks that happen just like in Europe or in even US.
Mm-hmm.
That's just one of the related avoidance of bankruptcy in Ethiopian context.
Yeah, I agree. But you still want to have some influencing mechanism. You want to be able to influence the behavior of banks. You do not currently have that. So just because you're not influencing the bank does not mean that there's not a problem. It just means that you do not know it. And when you finally come around to fixing the problem, it may be too big, or it may be something that you don't want to address because it's, too big to address in a very easy and comprehensive way. So the simple example, if your house is falling down, right, it's important to maintain the maintenance of your house every year rather than put it off until it's too late, because then your house is going to fall down. So you want to do maintenance yearly. And that would be my observation for the Ethiopian banking sector, that maybe the yearly maintenance is not being done. And when they finally get around to doing the maintenance of going and looking at the actual books, it may be a big surprise.
By the way, the protection, what Taye said is part of the regulation, in fact. But prohibition of foreign banks in Ethiopia also has, a counter problem. It inhibited the efficiency of banks.
Exactly. That's the point I'm making. So just because you have an inefficient banking system means that you're not able to be competitive on a world stage, which has sniffing for unemployment and so forth and quality of life, because you must become a partner. Eventually, you must become a partner in the global stage. It's inevitable. Because as you mentioned with our previous paper, Fintech will force you to become a global partner. And so when you pull off the scab and everyone starts to come in and say, okay, how tough are you? Let's see how tough you are. They're going to punch you in the stomach. The punch in the stomach is coming. So you need to know that. And when it comes, you say, oh, they punched, the world economy punched me in the stomach. Are you going to fall down or are you going to get up? That's the question. And so I think we have had a good discussion, and I think we have some great topics for next week, and I hope you guys have a great weekend. Anytime you have questions, let me know, send me an email, and I'll make time by Zoom and so forth. We can continue talking. And I think we had a lot of great topics today, so I appreciate your time.
Thank you very much, Professor.
Okay, take care. See you this weekend. See you tomorrow. See you Tuesday.
Thanks a lot.
Thank you.
Bye-bye.
Thank
Dr. Daniels, I want to just ask you apologies for power and internet interruption for some minutes, and for the inconvenience with the Zoom platform. Just first, please just give me your apologies.
Sure, no problem. We'll take care of it, okay?
Okay, thank you very much.
Take care. Bye-bye.
Okay, bye.